Hello and welcome to this latest Wealth of Advice market update recorded on the 26th of October 2023. Seems like a hell of a lot has happened in the world since we last recorded an update a month ago. We've been down to London last week over 2 days to see various fund managers, ranging from a fund manager who dialed in from Tokyo, spoke with him about how Japanese equities and such like are doing and what his thoughts are for the near future. European fund manager, there was a bond fund manager from Janus Henderson. We also saw legal and general investment managers, as well as the guys at Elston, and we've been in touch with Royal London fund managers. The first people we saw were from HSBC, who advise on multi-asset products, multi-asset fund range. They were very negative on the UK. They haven't invested a lot in the UK for a while now, and again this general theme that what's going on from a political point of view in the UK isn't conducive to get more investment coming into the UK, which sounds quite depressing, but to be expected really. I mean, again, you're hearing fund managers, not just the people at HSBC, but when we're at Legal and General Investments on the Friday morning, stressing how precarious the UK economy can be. The UK economy has actually surprised economists this year by holding up. The IMF, for instance, said we'd have the worst recession across the developed world this year. We haven't, we've avoided that. The general consensus of most of the fund managers were that, yes, we've done well to avoid recessions in 2023, but some recessions may come in 2024. We've heard this description of whether a recession is going to be a hard landing, i.e. it's going to be one of the bad recessions that you saw in the 1970s, early 80s maybe, or is it going to be a soft landing where growth just goes to an absolute minimum? Maybe have a couple of negative quarters of output, and that technically is a recession. We obviously hope that it can be a soft landing and we don't have the worst recession ever, but certainly in the last few weeks markets are pricing in that the recessions could be worse. Why is that? Well, this year we've rose interest rates quite a lot, quite aggressively. 14 consecutive rate rises is what we had in the UK. Every rate rise is expected to take months to filter through into the wider economy. We're now starting to see the effect of the first rate rise filter through. So a lot of people will say that you're trying to manage the economy by just constantly looking in the rear view mirror, by raising rates after inflation has arrived. But we've also had tightening going on where the central banks are trying to pull back out of the financial system a lot of the money that was given to the world for free effectively during COVID. So as a result of this higher interest rates, less money in the money supply, inflation coming through because the oil price, for instance, is going to go up with what's happening in the Middle East, that 2024 could be the year where we do have a few more recessions than expected. And as I say, this is what's really caused the volatility in the last few weeks. The lowest risk part of portfolios have been hammered. Government bonds, corporate bonds have been sold off massively, especially since, I mean, we all identified Kwasi Kwarteng's mini budget at the back end of last year. The bond fund manager we heard speak was very open and honest about this. In his opinion, bonds have been oversold to the point where bonds are really cheap. Now that's great if you're a brand new investor and you're putting money in now for the first time. You're buying an asset class that is down a massive amount over the last 14 months. The obvious question for our clients and our long-term investors is, well, I've been invested all the way through this, how long will it take to recover? And the answer you get back is, they just don't know right now. My question to every fund manager we saw last week was, will your fund beat cash in the next 12 months? So cash is now at 5.25%, and every fund manager, as you would expect, nodded their head and said, yes, I do believe that my fund will beat cash over the next 12 months. Stocks and shares, they believe, are still cheap. Again, with the market falls we've seen in the last few weeks, the S&P 500, for instance, being the best example, is right the way down to 4,200. It's 5-6% lower than where it was at the end of July. UK stocks and shares are not regarded as being expensive. Look at the FTSE 100 over the last 5 years and it's virtually flat. FTSE 250 being the same. So the stocks that are out there are quite cheap. When we were down in London last week, we got presentations given to us from about 10 different fund managers over the course of the 2 days we were there. This slide that we've put in now, I thought was an interesting slide that I wanted to share with you. The UK consumer, the UK voter who has to go to the polls next year and vote in the general election will often base how they're going to vote on how they're feeling they are financially, whether they're wealthy or not. And in the UK especially, we put a lot of our wealth or idea of how wealthy we are down to the value of our house. So clearly property prices crashing would be very bad for the sitting government. So 5% is not a very big drop at all. But this particular chart you can see on the screen now talks about the acute mortgage pain being felt by a small number of households. I know people who've got mortgages who've seen them come off a fixed rate deal and go into a variable rate that's much higher, and the next fixed rate that they lock themselves into is higher than what they were paying. Obviously, we all wish we had the foresight 5, 6, 7, 8 years ago to lock into a 20-year mortgage at 1% above base rate, which some people have got where these 2% mortgages will last for the next however many years. I didn't, most people didn't, but what this slide shows us as well is there is only 1/3 of households in the UK who are mortgage free, but only 2 million households where they're expecting their monthly mortgage payment, which is around 6% of the population, to go up by more than £200 per month. Now, if you think about how earnings have gone up quite a lot in the last couple of years, most people, yes, the mortgage has gone up, and yes, the cost of food and the cost of petrol, etc., will have gone up, but for most people, paying an extra £200 a month on the mortgage is not going to cripple them because their wages have gone up. So when we're thinking about a recession or a hard landing, it's not like previous recessions where you've heard people losing the house, being in a negative equity position, can't afford the payments, that sort of thing, mass repossessions. I can't remember the last time I heard anybody having a house repossessed. Again, go back to 2008. It was much more relevant when the financial crisis was happening that you were hearing of this sort of thing happening. So hopefully this is a good indicator of what's actually going on in the housing market in the UK. The one thing I would be worried about is the amount of people renting right now. It shows on there that there's 11 million people who are currently renting, and the cost of rent is going up and up. And I was reading an article this morning about students, for instance, who go away to university, and virtually all of their money that they get on their maintenance loan and such like is now taken up by paying for these extra high rents. So I think that's a problem that the government has to achieve some kind of solution for. But from the point of view of how it's going to affect the economy in 2024, I'm not expecting, as I say, a huge property crash, or this slide suggests we're not expecting a huge property crash, and hopefully the amount of mortgage pain that you're hearing in the press is maybe a little bit exaggerated from what the reality is. In other market news, if we look across the US, one of the biggest mergers and acquisitions in history is about to go through. ExxonMobil is going to buy another oil producer, Hess, for $53 billion. So it's absolutely huge, and it shows that there is consolidation going to go on in the oil and gas sector. The oil and gas sector is very profitable again. We heard the Prime Minister, a couple of weeks ago say that we're going to start digging for more oil in the North Sea. We've realised that we need to get more oil, we need to have more reserves of it. Yes, I know the climate change and the protesters aren't happy with this, but if you look at the price of oil going up and we have our own oil reserves and we want to maintain our energy security of our country, then maybe that needs to happen. But these oil companies are making a lot of profit right now, and as I say, seeing a merger of that size is absolutely huge. And the story that came out in the UK this week, this story was supposed to be released the week before, but for whatever reason the government held back on releasing these numbers, and maybe it's because it was a negative story, who knows, but the UK unemployment rate has gone up to 4.2%. And if you look at the chart you can see on the screen there, go back to pre-COVID when it was around about 4%. Obviously as a result of COVID it went up, came back down. As a result of it coming back down, more people earning, people had money in the back pocket from the furlough payments, etc. This was allowing people to go out and spend, and then we have inflation. So government raises interest rates, businesses are affected by rising interest rates and all the other rising costs they've got. Businesses may start laying off staff, businesses are not recruiting as many people as what they might have done previously. So from an inflation point of view, the unemployment rate going up to 4.2% is positive. Obviously for those poor people who have lost their jobs, there's nothing positive about it at all. But when we want to tackle inflation, as I say, the Bank of England has obviously rose interest rates 14 times consecutively. That ended in September. The Bank of England will meet again in the coming weeks to discuss what they should do with interest rates again. This may be a story which, if the Bank of England looks at and analyses, will say to them that we shouldn't increase rates from here because the previous rate rises have been working to try and tackle inflation. There are 7 stocks in the world right now which is being bandied about being called the Magnificent Seven. I genuinely hate it when this industry comes up with this sort of terminology. However, in this instance, as soon as I heard it mentioned by a fund manager a few weeks ago, I knew exactly who they were talking about. Nvidia, a lot of people watching this might not have heard of Nvidia, but they're the company who make the microchips that all of the AI stories are kind of being fueled upon, the big quality microchips that are going into mobile phones, laptops, other sorts of processors that are just making things work a lot quicker. Their share price since January the 1st is up 183%. Facebook 156%, that's Meta Platforms. Tesla 72%, Amazon 49%, Alphabet is Google, they're up 48%, Microsoft's up almost 40%, Apple's 34%, and the S&P, so this was done to the 20th of October, up to that point the S&P index was up 10%. So these 7 stocks represent a huge percentage of the overall S&P index. If you were to take these 7 stocks out of the American stock market, it shows you there that the other 493 companies on the S&P are down 1% overall this year. So again, it just shows you how much focus and attention is paid on these stocks from the markets. The fact of the matter is these 7 stocks virtually act like monopolies now. In every market that they're in, they're the market leader. The amount of money that they've got coming in is unreal. So some commentators will say it's a bad thing that these 7 stocks are so popular and so highly invested in. I personally think if they're going to do well, the market money's flying into them and it brings the market up, then happy days. I don't foresee a period where any of these stocks suddenly go bust or anything like that, because they're sitting on such huge, colossal cash reserves. They're absolute monsters of size of organisations, something we've never seen before in stock market history, really, where you've got such a concentration of value tied up in seven key companies. But apart from those stocks, nothing else has really grown in 2023. We've had some positive months, some negative months, and in the last few weeks, as I say, with what's happening in the Middle East kicking off, markets are really concerned, because how will inflation affect that? The oil price being the main driver of inflation at the moment. If you remember back to the positive news story last month of inflation coming down, food and other such items were coming down in price, or the inflation wasn't as high, but the oil price had gone up. So now we're worried what's going to happen over there in Israel and Gaza. How is that going to affect if Iran gets involved? Will that mean the oil price goes up? As we've said previously, we've got a general election coming in the UK in 2024. We don't know the date of that general election. I think it can be as late as January 2025 actually, but the last election was December 2019, and it has to be normally 5 years from that. So we're looking maybe towards the back end of next year, And we also have the US election, which we know will happen in November, because it always happens November every 5 years. President Biden is perhaps more focused on geopolitical risks right now. He's definitely getting involved with what happens in Ukraine and Russia, also what's going on in the Middle East. He was over there, and if you notice the rhetoric he used, it was a little bit less confrontational than maybe what you might have expected previously. He wants to see those geopolitical risks reduce, because it will help avoid a recession, it will help avoid high inflation. If he can make sure the oil price doesn't go nuts, then hopefully that means Americans can still spend money on other things and you avoid a recession. And the Americans are also obsessed by the price of gas at the petrol pumps, so he obviously wants to keep a lid on that. So talking about oil, the graph you can see on the screen right now is the Brent crude oil price going back to 2019, and as you can see where the price is right now, it's not that crazy compared to where we were in 2019 when it was just shy of $80 a barrel. We've been less than $80 a barrel earlier on this year. As I say, the situation in the Middle East and also OPEC reducing output earlier on in the year saw the oil price go up to the mid to high 90s, come down a little bit, and then we're back again. But compare that to where it was during the Ukraine war kicking off, and if you remember the UK politicians all on the news saying this price of oil going through the roof was all Putin's fault and this is going to cause this terrible winter. Well, that never really happened. We had a mild winter last year. Oil price went right the way down. So yes, it's going back up, but it's not at scary levels yet. Certainly nowhere near it was. We've mentioned geopolitical risk. This chart here was produced on the 6th of October. And as you can see, the Gulf tensions hadn't really escalated then, so this is why the arrow's on pushing the Gulf tensions higher up. But we're now in a position now where we have 3 really big geopolitical risks going on in the world. What's going on in the Gulf, Russia, NATO conflict, and US and China still at strategic loggerheads about what they're doing in all sorts of areas. And that's really, as I say, what's been driving negative market sentiment. in the last few weeks and months. Another slide that we found interesting that we saw last week, which hopefully you find interesting as well, is when we look at the breakdown of UK inflation, and this goes back to September 2021, and it shows you how inflation rose rapidly as we got up to the end of 2022. We got into 23. Rates have started to go up. The Bank of England's telling us that they're going to get inflation under control. Rishi Sunak had us believe that inflation would have been under 5% by now. How wrong was he? But you can see that key parts of the inflation story is coming down. UK inflation was headlined at 6.7% in September, which is the same level as we got in August. But as you can see from that, food price inflation has been the largest contributor. Food prices have eased, only up 9.9% in September, which was down from 11.5% in August, and that is the lowest point for over a year. Across in the US, their consumer price index looks a lot better than what ours does. All items came in at 3.7%. Less food and energy, and it was 4.1%. So the core US CPI of 3.7% in September was positive. The US are quoting that they want to see inflation down to 2%, but anything close to 3 or below 3 is going to be regarded as a success. And with everything that we've been talking about, this is the biggest story in town. If inflation in the US can go down to a good level, the Federal Reserve Chairman can finally stop spooking the markets by threatening more rate rises, and that's been another big contributor over in the US for the last 6-8 weeks of why markets have gone down, why bond markets have underperformed, is that fear that he's going to raise rates again. So if inflation across there can get below 3% or get close to 3%, and you hear an announcement from the Federal Reserve that rates aren't going to go up again and they may start talking about cutting rates in the new year, then the markets will shoot up. As I say, I've mentioned that on these updates previously, and as I say, so far we're waiting for that to happen. So we now come to the final part of the market update, where we look at how various stock markets have performed over certain time periods. And the one thing to say when these graphs come on the screen is how volatile they are, how up and down things have been recently. The first chart there, it shows the stock market performance since the start of 2023. The Nasdaq, which most of those technology stocks that we showed you in that Magnificent 7 sit, that's up 34% since January the 1st. Then you have the S&P up around 10%, but again, look at that chart, the S&P is down around 5-6% just in the last couple of weeks. The FTSE 100 only up 2.55% year to date, and the worst performing, the one at the bottom, is the MSCI Emerging Markets, down 2.79 so far this year. So very volatile time. When we just focus on the 3 big markets that we always look at, the FTSE 100 is the best performer over 12 months, going back to November 2022. Then the MSCI, then the S&P 500. But once we extract that over 5 years, the S&P is so far ahead. Again, you look at most portfolios, whether it's the Wealth of Advice portfolios, the Royal London ones, we now have, and Royal London have, and Prudential have, and all of the main asset allocators, HSBC, multi-asset, legal and general investment managements there, multi-index funds, most of them have a major weighting towards the US. It's the most dominant market. Those Magnificent 7 stocks are on that market. And what you're also seeing is some of the bigger companies that are coming to market to do a listing are heading to the US. So, as I say, we're in a very tricky, volatile time of the world right now. What happened in the Middle East a few weeks ago was obviously horrible to watch on the TV, the loss of life and the suffering that you see going on there. But from our point of view and the clients we have, investors' point of view, it was genuinely the last thing we wanted to see happen right now. It just as we were feeling markets were moving ahead, maybe inflation was getting under control, you have this other big massive event that goes on in the world. So what we have to hope for now is the politicians get together, stop everything escalating, the markets can calm down as we get towards the end of this year and hopefully into a more positive situation in 2024.